Did you know credit card companies earn billions every single year? Not from what they lend, but from how people use their cards? It's true. Today, we're uncovering the hidden system that makes credit cards one of the most profitable businesses in the world. At first glance, credit cards seem convenient. A simple swipe, tap, or click, and your purchase is done. But behind this convenience lies an intricate web of psychology, fees, and strategy designed to keep you spending and paying more than you realize. Let's start with the biggest moneymaker, interest rates. Credit cards charge some of the highest rates in consumer finance. The average is around 20%, but for some cards, it can climb to 30% or more. That means if you carry a balance of $1,000 and only make minimum payments, it could take years to pay off, and you might end up spending $2,000 or more in total. This revolving debt is the golden goose of the credit industry. While other types of loans, like mortgages or auto loans, have clear repayment schedules, credit cards are open-ended. The longer you owe, the more you pay, and that's exactly how banks like it. Now, let's move to fees, the silent profits hidden in your statements. Annual fees, balance transfer fees, late payment penalties, foreign transaction charges, over-limit fees. Each one may seem small, but combined, they generate tens of billions in profit every single year. These charges hit hardest when people are already struggling. A single missed payment can add $35 instantly, and once that happens, your interest rate might jump higher permanently. It's a punishment that keeps making the bank richer while trapping the consumer deeper in debt. Next is a revenue stream most people never see, merchant fees. Every time you swipe or tap your card, the merchant pays 1% to 3% of that purchase to the card network. This is called an interchange fee. It might sound harmless, but multiply that across billions of transactions and you get an enormous river of money flowing to Visa, MasterCard, and the banks that issue their cards. And here's the twist. Merchants don't just absorb that cost. They build it into the prices you pay. So even if you pay with cash, you're indirectly covering the fees for card users. It's a hidden cost built into every product and service. Now, let's talk about rewards programs, one of the most brilliant marketing tools in finance. Cashback, travel miles, and points make consumers feel like they're winning. But the truth is, these programs exist because they make you spend more. Studies show that people spend up to 20% more when using a rewards card compared to cash. So, even though you might earn 2% cash back, you're probably spending far beyond that in unnecessary purchases. And where does the money for those rewards come from? Higher merchant fees and higher interest rates, which you and others ultimately pay. Even if you pay your balance in full every month, credit card companies still profit from data, a massive, invisible industry. Every time you buy something, that data point is recorded, analyzed, and often sold in aggregate form. Your spending habits reveal where you shop, what you like, when you travel, and even your financial stress levels. That data becomes a valuable asset sold to marketers and financial firms looking to predict consumer behavior. And that brings us to the psychology of credit. Credit cards are designed not just to lend, but to influence behavior. Everything, from the font on your bill to the wording of your rewards, is optimized to make you feel comfortable spending more. For instance, billing cycles often end just before payday, encouraging you to spend again right after making a payment. Minimum payments are kept low to make debt look manageable, but that means it takes longer to pay off, generating more interest. Even card colors, black, gold, platinum, are chosen to evoke emotion and status, linking spending with prestige. The system also uses anchoring and reward timing. Points and cashback are often delayed by weeks, creating anticipation that reinforces spending habits. You're rewarded for using the card more, not for managing your money well. Then there's promotional interest offers, 0% APR for 6 months, 12 months, or even 18. These offers sound great, but they're traps in disguise. Once the promo ends, any unpaid balance starts accruing high interest, often retroactively. Many consumers who plan to pay it off before the deadline end up missing it by a few weeks, falling straight into the profit zone for banks. And while all this is happening, credit card companies use credit scores to keep you loyal. Your score depends on consistent card usage and timely payments. So even if you want to stop using credit, you're incentivized to keep spending to maintain that score. It's a cycle. Spend to build credit to borrow more to owe more. But it doesn't stop there. The industry thrives on economic downturns. When the economy weakens, people rely more on credit to get by, paying bills, covering emergencies, even buying groceries. That's when interest income surges. What's bad for consumers often turns out great for credit card companies. Let's put it in perspective. Imagine 100 million people each carrying an average balance of $2,000 at a 20% interest rate. That's $40 billion in annual interest revenue, and that's before counting fees, data sales, and merchant charges. The scale is staggering. Yet despite all this, credit cards can still be used responsibly. They can build your credit history, offer fraud protection, and give you short-term flexibility. The difference lies in how you use them. Here's what financially savvy people do. They pay their full balance every month. They never chase rewards. They let rewards work incidentally. They track billing cycles carefully. They use 1 or 2 cards, not 10. And they view credit as a tool, not free money. When used like this, credit cards can work in your favor, giving you benefits without trapping you in debt. But the moment you lose track, the system wins. Now, here's the part most people overlook: the global impact. Credit card debt isn't just an American problem. Around the world, billions of people are entering the same cycle of revolving debt. Emerging economies are embracing credit culture fast, and that means the same business model, fees, interest, and data monetization, is spreading globally. In countries where cash was once king, digital payment systems are opening a new era of financial dependency. This isn't necessarily evil, but it is strategic. The more people depend on credit, the more predictable their behavior becomes. And predictability is what fuels financial control. The truth is, this isn't just about credit cards. It's a reflection of how the entire financial system operates, using complexity and psychology to make everyday consumers the product. Once you see it clearly, you can break free from it. So the next time you swipe your card, remember, every transaction tells a story. Every purchase earns someone profit. Maybe the bank, maybe the merchant, but it doesn't have to cost you extra. Knowledge is your best financial defense. Read your statements. Challenge hidden fees. Pay early. Spend consciously. Because in a world built on credit, understanding the system isn't optional. It's essential. There's much more to uncover about how everyday finance operates beneath the surface. And understanding it, truly understanding it, is the first step toward mastering it. Keep learning, stay aware, and explore the unseen world of money, right here on Wealth Lens.